Welcome. My name is Sasha Moore, and I'm delighted to moderate today's Market Update live webinar with industry veteran and financial services specialist Nick Young, who is also the managing director and founder of the leading trail book company, Trail Homes. Welcome, Nick.
Good morning, Sasha, and thank you, and welcome to everybody in the room today.
Yes, indeed. So we've got a whole load of insights today. So what we'll be covering in this session is we'll be overlaying Australian Bureau of Statistics data, which we'll be referring to ABS data, with market conditions to provide some insights on how the GFC and COVID-19 provide indicators for the emerging market that is on the horizon, the current state of course correction, and having a look at whether or not it's as bad as expected, looking at the notion of the infamous fixed rate cliff and whether it is in fact that, or perhaps a more marginalized version, which is perhaps called a mortgage hump. Changes in the lending landscape, looking at some seasonal trends and what's happening about the domestic and international variables and how that's affecting our market in Oz, and then looking at expectations for 2024. So we also encourage you to feed through any questions that you have via the chat function, and we'll address these either if it relates very specifically to some data, we'll address that then and there, or we'll also have some general Q&A time at the end of the webinar. So let's get cracking, Nick. So let's put you in the hot seat. Let's start with how the GFC and COVID provide indicators for what's coming next. Nick, I know you've got some graphs. So if we go to the first graph, maybe let's start with having a look at what this graph is telling us.
Okay, so you've got up here, as Sasha mentioned, we're going to go through today some of the ABS numbers, which I think are obviously a very good reference point because you can't get anything better than the ABS, but it's a really unusual chart. As you can see, this one starts in 2005 and it follows lending along from since then. The top line being total lending, the next line down being owner-occupied, and the bottom line being investor. So if we just look at the top line, you can see that there's been a general increase, slow general trending up in lending over the years. And then, of course, we get to COVID and it just goes ballistic. I mean, it's literally, it just takes off. Now, I've had this, last time we spoke, we had this graph up here. It wasn't quite as progressed as this one is, but you can see this huge jump that occurred. So if we go to when COVID started, which was down here in 2019, total loan commitments at that stage were running, $16-17 billion a month. And by the time we get to the peak at the end of COVID, we're up to over 30 billion a month in lending. So, we near on damn well as double our activity. And of course, this is all about the RBA just pumping the economy full of liquidity. You'd all be aware of it. You could, which we'll get to in a second, but you could effectively, if you're a major Australian bank, you could borrow from the RBA at basically 0%. And that was them just trying to push money in. Now, with the benefit of hindsight, and I think everybody with the benefit of hindsight would probably say they actually pushed too much money in, but it's a huge jump there, Sasha, and it's really that hump that we're now starting to digest.
So I think on that note, I think when we're talking offline, I think it's a very interesting area to discuss where we are now coming off the back of COVID, and to have a look back at what the GFC has shown us statistically. And actually, before I do that, I do want to segue. One of the core reasons why Nick and I decided that we would talk about the ABS data so much is to very much put into perspective what's happening. And obviously with media, it's very easy to have a doom and gloom expectation. But the reason that I love this data is if we're looking historically, if we're looking over, call it, a 20-year, 10-year period, we can start to get insights and we can start to get cues about what is going to happen next. And the reason I think that that's so valuable is it gives, it's not crystal balling by any stretch, but we're looking at the data to provide us very clear cues that historically are consistent. So just that sort of with that in mind, I'm really interested, Nick, in just dissecting a little bit what's happened around the GFC. And in particular, perhaps we'll also go into what the GFC actually looked like, because I know a lot of the younger brokers who are attending today may not have really experienced that in a professional capacity. So what I would really like to do is just unpack what that was like in sort of 2007 and 2008, 2009, and what we experienced then, and what indicators from the recovery off the back of that GFC we can now start to apply in terms of what we can then forecast to be likely moving forward.
And indeed, Sasha, it's a really interesting time to go back to 2008. So you've got to almost put your hand, if you can, over everything on this graph, sort of to the right of my pointer. So just sort of pretend all of that doesn't exist and pretend that we're traveling along in this world here. And if you look at the dates down the bottom, we're running up to 2008. And as you can see there, a little bit like what we did in COVID, we start in the low teens, and by the time we each reach the end of it, we're in the high teens, which you think about percentage movements, it's not quite doubling like we did in COVID, but it's, you know, it's a pretty damn big increase in a percentage sense. Times in running up to 2008 were booming. Right the way around the world, it was a good time. Unfortunately, like all good parties, that comes to an end. So for those of you who weren't around, effectively the bond markets all seized up, and effectively it was very, very difficult to borrow money, and there was a shock that went right through the world. And indeed, if you had a poor credit rating and you're a country, you weren't borrowing money at all and was pretty sick. So we then saw this downturn. Now, if you're a market watcher, for every sort of basically action, in fact, Einstein also came across with a theory about this, there's an equal and opposite reaction. So, you know, what comes up must sort of come down. Hopefully over time you end up doing more ups than downs, but if you get a big up, you're invariably going to get a big down. And indeed in the GFC, the down was actually bigger than the up. It was a big shock to the system. So we ended up at a lower point than arguably when we started out. So it was not pleasant. So flipping forward to now, which is your question, Sasha, my fear when we entered into this game and I started seeing this graph, and then more importantly, started to see us coming down the other side when effectively the RBA turned off liquidity, is my fear was that this chart was actually going to continue on down, and we were going to get down to levels of lending that we haven't seen since maybe even 2011, you know, right the way back at this sort of time, we could have easily gone down into that sort of country, which would have been a recession. I mean, there's no two ways about it. It would have been very nasty. The surprising bit is this little hook. So about 2 months ago, 3 months ago, the Australian economy actually bounced. And I think, and it's also coincided with the rest of the world bouncing. And I think every economist in the world basically has gone, oh, I wasn't quite expecting that. Some of them were obviously more optimistic, but I don't think any of them really picked that we were going to have this bounce. They were either very bearish, a bit like me, or fearing that this could get really nasty, or they were hoping for some sort of soft landing. But none of them were actually talking about a bounce, which is what's occurred. So whether that continues or not, we'll talk about it in a sec, but the fact that it's bounced is a really interesting point.
Okay, and I agree. It is a welcome unexpected turn, but I would also like to overlay that with obviously consumer sentiment and general inflation, mortgage stress coming into play. What are your expectations with that uptick? Just based on, again, not crystal balling, but looking at historically what we've learned from the GFC and other. Is your expectation, being an analyst, because I know that you constantly review data, how are you feeling that current sentiment and overall pressures, domestic pressures, are going to affect that uptick?
I think we're basically treading on ice at the moment. It's sort of holding, and it's okay, but you just get, well, I get this feeling that the danger is on the downside. You could easily find us falling through the ice, and we just don't really know how strong the ice is. So we do know that the RBA wants to get the level of activity down. Inflation is too high. We need to get it down from having a 5 in front of it to hopefully even having a 2 in front of it, certainly to have a 3 in front of it. They've got an agenda that they're prepared to wait 2 years. They're prepared to be patient. But we've actually got a set of inflation numbers coming out tomorrow, and everyone will be watching them very, very closely. We're expecting them to show a bit of an uptick because the cost of energy has gone up, and particularly petrol in recent times. But what they'll be looking past that and looking at the broader economy. And if the broader economy is showing that is growing, then we're odds on, I think, for another interest rate rise. Probably that'll be the last one, but it's whether we do get one more interest rate rise, I think, is the question mark, which we probably answered largely tomorrow. If we do get another interest rate rise, that's going to flow through to those people who are very highly geared. At the moment, if you look at overall borrowing, and I'm sure everyone in the room is probably aware of this, the level of actual delinquencies, people going bankrupt, is not that serious. It's again holding probably better than what people thought, but again, I just get in the feeling that, you know, one, if we had to do another 2 interest rate rises, you would start to see the 10 pins starting to fall. But hopefully we don't need another interest rate rise. But if it's only one more, then, you know, I suspect the Australian economy can hang on and survive through. But it'll be very interesting looking at tomorrow's numbers.
Yeah, indeed. And I guess the other area to overlay with that is the liquidity savings bubble has largely been exhausted, meaning that people's savings are, you know, obviously being at a high through COVID. That bubble, that savings bubble for a lot of borrowers has now been exhausted. So I think that, to your point, the true effect of an increase in rates will be very raw for a lot of people, because there isn't that cushioning or that buffer that perhaps has helped make the recent changes or the recent increases so impactful.
Indeed.
So let's maybe go through to the next chart, which details external refinancing. So Nick, if you want to just share your screen again, let's go through the external financing chart, and let's have a look at what this starts to tell us. So Nick, perhaps if you can start to discuss this from an overall perspective, again, looking at historically, and then start to drill down into owner-occupiers versus investors and what insight this data is giving us.
So again, similar to the previous chart, we've got the top line being total refinancing, and that's made up of owner-occupied and investor refinancing. So again, you know, it's a chart out of the box, and it's dominated by COVID. And you can see it again, that old story of we trundling along, having a happy time in Australia, and then COVID hits, and then the economy gets pumped full of cash. And effectively, and hopefully everyone in the room participated in this, the thing about, if you're a major bank, being able to borrow from the RBA at basically 0%, it meant that you can, and by the way, when they were doing that, they could borrow for about a 3 to 5 year window at that very low interest rate. So what the banks did is they went, you beauty, we'll knock out a fixed rate home loan product at, let's say, 2%, maybe a little bit more, maybe a bit more, but maybe a bit more. So the Australian public, a lot of people say Australians aren't very bright, but if if you actually look at Australians en masse, they're not actually completely and utterly stupid. And what a
Like
lot
to
of
think not.
Australians did, with the help of
Present
their
company
mortgage
included.
broker, what a lot of Australians did with the help of their mortgage broker, of course, is refinanced into a fixed rate product. So there was an explosion. I don't need to tell anybody in the room, and as I say, hopefully everybody participated in it, in effectively 2 to maybe out to 5 year fixed rate, locking into a new product. And we saw that kicking off. So you can see a huge jump as we start off, and then it slows down, but then we go again. And effectively, it was a bit of a bonanza, and we'll talk about this a little bit later on. You would then expect, and this is again where sort of the unexpected happens, that once COVID ended and effectively those fixed rate specials came to an end, that you would see the refinancing boom effectively slow and us return back to something normal. And it hasn't. It's just kept on going and going and going and going. It is still going. And every time I see this chart, I sort of go, come on, mate, you've got to slow down. I mean, this is, you just cannot keep on doing this forever. And clearly it can't do it forever. I mean, it's got to get to a point where it stops or at least slows. But at the moment, it is still climbing. And, you know, yes, you could perhaps look at the very last month and say, oh, there's been a downturn, but, you know, a bit of a rounding error. This is still heading up. If we look at how and where the activity is, again, you can see that it's the owner-occupier that's really been the one. And my only thought, well, there's 2 thoughts here, and it's probably both anecdotal, is that one, as interest rates have risen, people have focused in on them and gone, right, can I get a better rate? That's the first thing. And secondly, I think the average Australian borrower is much more aware of refinancing, rates, banks being competitive, cashback opportunities. It's been effectively coming at them from all sides pretty non-stop since COVID. In fact, you know, broadly when COVID started, but it hasn't stopped. So whether it was originally a fixed rate, then it was a cashback, then it was a bit of pressure on, you know, it's just costing me a lot. They are watching very closely any refinance opportunity. That said, we've got to be, as I said, getting to a point where those who can refinance have refinanced, and you've got to expect this thing to slow down and turn down. And certainly if I was a betting man, I'd have to say we probably have reached a point where it can't go any higher.
I know it's crazy, and I concur. You know, as you know, we work with a lot of lenders, and it has been surprising all around that the refinancing has continued to have that upward tick. And my observation, just from a market perspective on that, is COVID has actually done borrowers a massive favor and removed that set and forget mentality. And what's also really interesting is I work in commercial finance a lot, and debt consolidation for a lot of lenders is at a record high. So I feel that COVID has actually had a really good byproduct in terms of shaking us up a little bit in terms of how we look at our finances, made us more on the front foot with our finances, and that finances being personally your investment, your business, and so on and so forth. So I think just one thing I would also like to just touch upon is particularly investor appetite for the property market and what that refinance chart does speak to. Nick, what investor trends have you noticed? Are you seeing a consistent interest in property, or are you seeing more of a divergent strategy?
Well, it's sort of clearly the level of activity and property sales, just outright property sales, is down. You just look at the number of properties that were coming to market 3-4 years ago, and the number are coming to market today, it's down. And, you know, it's holding. Clearance rates are high, but the actual volume of properties is not at anything like historical highs. You then start pulling inside that And it would appear that the owner-occupier is actually becoming much more popular at the moment than the investor. We're just not seeing that investor appetite like we used to. And if anything, we're actually starting to see what might be classed as investor properties, some of them being sold. I'm sure anecdotally people in the room are aware of people who owned a number of investment properties might be deciding to sell one. We're also seeing a lot of holiday houses, particularly in Victoria, where stamp duty's gone through the roof. People actually reassessing whether they're actually using that holiday house that in reality they haven't been to in a year, so let's perhaps move that out. So I think there is a little bit, it's not by any means breaking apart, but I think the investor market is a little bit on the back foot where it's the owner-occupier, and particularly actually some of the younger people, which is amusing. Amusing in that I would have thought that they're the ones who probably find servicing a mortgage the hardest thing to do. But interestingly, they're in there and they're out there on Saturday mornings buying. So if anything, they're winning the race at the moment.
And I think something interesting to that point as well is with the investor market contracting, that may perhaps also be affecting the rental market. And perhaps that's also driving first home buyers more so because rent is becoming, well, I know particularly based in Sydney, it is becoming increasingly challenging. Yep. So do you have any other insights in terms of why first home buyers are being more proactive or being more aggressive about purchasing?
I think you've hit the nail on the head, Sasha. It's vis-a-vis paying rent as opposed to paying a mortgage. I mean, yes, the mortgage is going to be more expensive, but have you seen that rent bill? So
yeah,
that's what they're doing. I think also a lot of people during COVID did actually get a chance to build up a decent deposit.
True.
So we spoke about how people are running down their reserves, but if you look inside the pie, there's also people who have saved a lot of money.
Yeah, I think you're right. And also particularly my observations through COVID were there were a lot of young people through COVID who did go back and live with their parents, which also would have helped them save for that deposit in a high savings environment as well.
Indeed.
Okay, well, let's move forward. So, Nick, if you don't mind just going to your next graph. I'm really looking forward to this discussion because the rate cliff, fixed rate cliff, which has been used extensively in our vernacular, has been anticipated for months. But further to what we were talking about in the first graph, it seems to be a much softer landing than what was initially expected. So again, when we were talking offline, I really liked that you were referring to more of a mortgage hump than a cliff. So maybe if you can talk us through this chart, give us your insights, and then sort of really let us know where we're sort of looking at with that cliff versus hump piece.
So indeed, so just to look at the graph. So the top line is variable rate lending, and the second line is fixed rate. And of course, if you look at the dates here, you can see COVID, and this is the hump. So, and as we've been talking, through this presentation, there was an enormous amount of fixed rate lending that went on during COVID, and that's it. It's a huge hump. Now, most of it, and again, most people in the room will probably know this, but most of the lending was done into two-year product, a little bit less into 3, and then progressively less into 4, and a little smidgen of 5. But so if we look at let's say when this was at its peak, which ran from May 2001 through to let's say November 2001, and we roll forward 2 years, effectively we've now reached a point where all of this stuff here is starting to mature. So and people in the press talk about this cliff where people go from paying 2% to paying 5-6%, and that's a big shock to the system. And yes, it is. But if you think about it and look back at this chart, it's a period of time that we're moving through. So it probably started, if you think about that 2 year, it's the first of them started rolling off from these ultra low rates to normal rates much earlier this year. So let's say March, even sort of February of this year, and they will continue rolling off all the way through to the end of the year. So if we look at it here, it was sort of January 2022. So, and it's not really until you get to about May 2022 that you start getting back into what we might call normal levels of activity. So it's right the way through till May next year before we really see this thing back to what we might call a normal market, where we've got this hump that was generated during COVID effectively washed through the system. We'll then get the residual, 3, 4, 5-year ones rolling through, but they're not a big number. The big hump is happening right now. So we're probably, if anything, we're only in the middle of the hump, and we're going along with a lot of these people coming off, which again, I think really ties back to another reason why this previous chart is still heading up. So if you're in that position, and you probably, as I say, we're only halfway through the hump, we could actually continue to see this thing holding and maybe even increasing a little bit more before we actually see it turn down. And it all relates back to just this enormous wash through. So if I can
go ahead.
Yeah, no, I was, I don't know whether people have noticed it, but it's got a little bit of press. The RBA's put its hand up that it's lost $43 billion last financial year. Now, the Reserve Bank is normally a good profit. It makes good money. So effectively, it's borrowing at nothing and lending to the banks at quite a reasonable margin. Obviously, during COVID, it was around the other way. It was paying real money and lending it out at a loss. It lost $43 billion. That $43 billion has been effectively, much of it, transferred to Australian homeowners through their mortgages, through this whole fixed rate game. It's an extraordinary wealth transfer. We've also got to pay for it at some stage. But at the moment, those people on those fixed rate loans are enjoying that 43 billion. Anyhow, bit of an aside there.
Indeed. But one thing that came to mind is we are in this perhaps a self-perpetuating cycle, because if we go with that theory of very much borrowers moving from that set and forget mentality, really being on top of their finances, being acutely aware of inflation. I know anecdotally from my circles, everyone who has come off a fixed rate has now done the next fixed rate because of that uncertainty. So I think that just again, sort of overlaying, if we are in a more proactive financial position, I would expect then the hump and then that refinancing to actually continue to spike, because those 2 and 3 year periods are closing and they are naturally starting to open or start to encourage that next commitment. Would you agree, Nick?
Yeah, so, this chart, how long will it go on for? Can it keep on rising? The reality is, even if it just went sideways from here, it's still an extraordinary level of activity. And yes, I agree with you. It could hang on, and you could arguably see this continue for, as we've spoken, through to May next year, maybe. There's also chatter. CBA lost market share. That's never happened before. CBA hates losing market share. They're also, of course, the biggest bank. If CBA decides they want to win back market share, it almost single-handedly means we're back into mortgage wars. Now, I don't think we'll see cashbacks. I think they're probably dead and buried for a while. But if CBA does start coming out with aggressive offerings, then you can expect all the other banks will follow. And we could arguably be back into another whole refinancing blitz again. So keep your eye on those CBA rates.
Good tip. So let's talk about moving forward. So we've looked at obviously the indicators from the past. Let's now talk more holistically about what that tells us about 24 and what to expect there. So if we now look at that we're in a current state of more of a course correction, is that as bad as was initially expected?
Well, no, and in fact, let's go back to this previous chart here. We have had this bounce, and very good question. What can we expect to see next year? So we've spoken about the level of refinancing. Well, we expect to remain strong, certainly for the first, getting us through to May. We then potentially, I think, go into a quieter period of time. And I think this is something we should bear in mind. If we sort of look at recent times, you might think that, the Australian economy riding, high 20s, even into the $30 billion worth of loans every month was normal. In reality, if we look at where we are and look at, more importantly, where we've been historically, this level of activity we're seeing at the moment is actually probably about normal. This is, in fact, if you were to sort of think about this as a channel, we're actually probably slightly at the higher end of what is normal levels of activities. We could actually be a little bit quieter, and this graph would be looking pretty normal. So, a level of activity in the low 20 billion each month is, and I think that's probably where the RBA would like us to end up. So I think we need to think about this as being the new normal, or back to the old normal. And we've got to somehow, a bit like the economy, we've got to wash out of our brains the level of activity and frenetic pace that we're running at during COVID. That was abnormal, and this is the new normal that we're in now. So whether you like it or not, this is sort of probably about as good as it gets. I'm not saying it's going to be doom and gloom, but this is probably about it.
And in terms of that recovery piece, how do you think that that's going to materialize with spending, purchases, housing markets?
So, I think it's sort of, this is it. I don't think, in fact, if anything, I think we might be, the RBA, and the RBA always wins. The RBA wants it to be a little bit quieter. They want us to be spending a little bit less. They want housing prices not to be roaring away or, jumping up. They would like to see this chart turning back down a little bit and going along at a slightly lower level. So it's not saying that they want to halve it or anything like that, but they'd just like to keep that damper on it. Throw a blanket over, just continue to slow it down quietly. So whether it's spending on Christmas presents, going out to dinner, going on overseas holidays, I think we're basically as good as it gets, and we might actually just have to very slightly get used to the belt just being a little bit tighter. Not dramatically tighter, but just a little bit tighter.
No, indeed. And are you familiar with how this stacks up on a more global stage compared to other markets?
So we're broadly, our story is not too dissimilar from the American story. So if anything, the American story is probably a little bit more of a bounce on the upward. There is more talk there that they're going to have to not just do one rate rise, maybe two. The American economy has also got a huge debt overhang, and at some stage that needs to be addressed, and that's about repaying rather than actually just borrowing more, and that always hurts the economy. So that's the American economy is. The European economy, will leave England out, but if we just look at Europe, the European economy is a bit of a mixed bag, as it always is, but in many respects that's actually going along better. It's in probably a better groove than what Australia or certainly America is. The UK is a bit of a problem at the moment, and probably will remain a little bit of a problem for a while here, but continental Europe's doing okay. We then, of course, have I think Donald Rumsford said the known unknowns.
Yeah.
I won't list them, but they're all pretty obvious, and they're on our, the news every night. We've got some really serious problems that could get seriously out of control. Whether it be, China deciding, right, we are going to go into Taiwan, whether it be the Middle East, whether it be the US debt situation. There are some really big things that if they fell off the table, it will be, horrible. And, the best we can hope for is that they don't fall off the table. So there's a little upside. There's a lot of downside. I was, and an aside, I was reading this morning, he's an Australian, but he's the head of Lloyd's Insurance in the UK. And he was making the comment that it's actually a great time to be in insurance because there's a lot of volatility, there's a lot of unknowns out there, and people, of course, want insurance. They want protection. Hadn't actually thought about that. As I was thinking it might actually probably be the worst time to be in insurance, but he seems to think that's...
There's always a silver lining, isn't there?
There is indeed. There is indeed.
And actually, you just reminded me of something. We work quite closely with some SMSF lenders and SMSF auditors, and just back to what we were previously talking about with that set and forget mentality. I think that one of the other areas that I've noticed is that people are now really applying that microscope on their finances across the board. And when I've been speaking with these SMSF auditors and so forth, they're seeing record growth in SMSFs. And it's really interesting, the ATO's spotlight equally on SMSFs as that industry substantially grows. So I think this set and forget, moving away from that mindset, has far-reaching implications to the broader finance industry, apart from obviously the housing market. And equally off the back of that is I would expect that insurances are booming at the moment because it sort of flushes out everything. If you've got your spotlight on your finances, then your insurances and SMSFs and so on and so forth are also going to naturally more perhaps come under in focus, opposed to just being placed in that too hard basket.
Indeed.
So moving on, let's talk about the lending landscape, because obviously every change or every movement, that action reaction. I know the lenders that we've worked with have made some substantial product extensions, particularly through that COVID period, but equally now are more retracting to their core offering. What have been some of your, let's start in terms of the tiers of lending. So we'll start sort of your major lenders, and then we'll go down to the sort of the non-bank and then private fintech area. So what changes have you really noticed in the lending landscape, starting with your majors?
We touched on this a little bit before. The mortgage wars have come to an end. So Westpac is still a little bit out there, but the others have all really pulled their heads in. And I think it's an interesting thing to note. If you look at a cashback, and it's worthwhile remembering this going forward, the reason cashbacks were out there in such force is that the actual quantum of the cashback, the banks were writing off over about a 5-year period. And that was off the back of the fact that your bank was assuming that mortgage on average would last about 5 years. Now, what's happened behind the scenes is APRA's come along and gone, actually, the person who takes up that cashback offer, on average, they don't last 5 years. They are actually attracted to these sorts of offers, and on average, they're probably only lasting about 3 years. So we want you to be writing these cashback offers off over 3 years, which suddenly turns that mortgage from being marginally profitable to being a loss. And of course, you can't run a bank if you're losing money. So that's what brought it to an end. So it's also why I don't think that we'll see cashbacks reappearing in a hurry, because if we started them up today, everybody knows the way we account for this means that we're going to actually have to be just losing money. So if it's going to happen, mortgage wars, we're going to see it just, I think, with sharper rates rather than anything else at this particular point in time. So we're waiting and see. We keep our eyes on Commonwealth Bank. at this stage, they're not doing anything. They're happy, I think, just to play forward. But that'll be them watching them.
But I think you did also raise a very interesting point in terms of the CBA being more aggressive in terms of their market share. And it may be a very unexpected environment where if CBA starts to come out with extremely attractive rates and, you know, the other majors follow suit, that may in turn just buck all of the inflation and buck the effects of that inflation as well. So it'll be interesting to see how that plays out. So the other thing that I've also noticed in terms of the major lenders is their credit profile has restricted, obviously, substantially. So very much, again, coming back to their original wheelhouse of those sort of vanilla home loans, those vanilla refinances and so forth. And with such a restriction and continual restriction of credit, then that's obviously had a massive, massive ripple effect to other areas of financial services. So let's maybe talk about, again, what you have noticed within that non-bank fintech sector.
Yeah, so there's probably two areas. One is private lending, and then the other one is the securitisation market. So let's deal with securitisation first. That market, it's still open. The securitisation industry's out there, clicking along, but the pricing is by no means as competitive as what it was. And in fact, it really, if you're talking about a AAA mortgage, it just doesn't really stack up anymore. So, and to put this sort of in, what sort of a mortgage broker might see, you've probably had advantage by supporting some of the products that your particular aggregator's been using. It'll be no surprise to you, Advantage wasn't as competitive, or is not competitive today as what it was 2 years ago. 2 years ago it was very competitive and was winning a lot of business, and it was because that securitisation market was so much stronger. I don't expect to see any great improvement in the securitisation market for some time. It could, a year, certainly, before I could really, see that turning around. So those securitised lenders, being able to bring out a AAA product that will compete with whether it be a CBA, Westpac and ANZ, or a National Bank or Macquarie Bank, it's not going to happen. So we'll see them on the back foot. The private lending market has been booming. What I'm finding interesting now is, to use that lovely expression, they're up to pussy's bow. They're full. So you've seen a lot of, so just for those who aren't sort of conscious of this private lending market, there's been a lot of activity in, let's say, a property developer. I'm doing a property developer. I need to borrow money for 18 months as I effectively cut up my 10 acres into quarter-acre plots. So I need to put in some roads and some stovey poles and electricity, and then I'll be able to sell it out and we'll all make a lot of money. Now, a traditional bank doesn't like that. And we've seen a lot of lending activity for that sort of player who has come in, first mortgage, 70% LVR, interest rate of, 8, maybe out to 12%, that sort of game. From an investor's point of view, it's regarded as pretty low risk, and it probably is. The problem that's happened is that the 18-month loan is suddenly now 3 years. And it's the borrower going, I'm sorry, everything's fine, but I just can't get the person to lay the road. I mean, it's just, he's full. I just can't get it through planning. I just can't this, I can't that. And it's not their fault. It is genuinely delays out of their hands. The bloke's not going bankrupt. It's all actually fine. The interest rates are still being paid. It's all being serviced. Nobody's gone broke. But it just means that 18-month loan has suddenly gone to 3 years, which sort of, when you look at it the other way, it means the availability of funds for that sort of lending has sort of halved, which is why we're now finding that market, we're seeing the rates starting to push up again because the availability of funds is sort of tightening right up. So The further you get away from AAA, so if you think about that AAA mortgage, if anything, that might get a little bit more competitive. But the further you get away from that, it's going to be harder to get the funding, and the funding is going to potentially be more and more expensive.
Yeah, indeed. And also, we were talking offline from an aggregation perspective. What are you noticing in terms of more from that aggregation piece?
So it's probably the loan market merger's been the big one here, but we are continuing, I think, to see a divergence. There's some very, very big aggregators. I won't name one of them, but we don't need to name them all, who are coming out with very competitive offers, often built and typically built around software. The software is tending to get deeper and broader. When I started out in the industry, there was no software. Then we had a little bit. The sort of software teams that these big aggregators are now employing are huge. They are massive investments. So I think we'll continue to see that game being played. I think in some respects we're seeing a bit of a morphing of aggregation into almost tech. It's less about, can I take you out to lunch, and more about, can I provide you with some really good software and arguably, extend it further into your business than you've ever used it before. So I think that trend will probably continue. We are also starting to see the emergence of some smaller boutique aggregators that are much more focused in on service. So, arguably going back to where we almost started the aggregation game of, let me get really close to you and really help you build your business. And often we're seeing those boutique aggregators partnering up effectively with one of the really big aggregators, so you get the software as well. So I think those trends will probably continue. I don't see any reason why they'll stop.
And I concur, and particularly on that software piece, I think that's a critical investment to help brokers to diversify. So there does seem to be a lot of focus on that tech piece, but I think it's ultimately really positive in terms of really supporting that business growth from a brokerage's perspective.
We're seeing that the banks as a general, they continue, whether they're doing it on purpose or being forced, but the whole distribution piece is continuing its march into the hands of the mortgage brokers. So, I don't know where it'll stop, but it wouldn't surprise me to see 90% of home loans being done through mortgage brokers by the time this game's played. But also asset finance, also commercial. It's really just in many respects starting its march into the hands of mortgage brokers.
Yeah, I agree. And I'm also very encouraged by the number of brokers who are now diversifying as well and actively diversifying. And to that piece as well, really focusing on upskilling in various aspects or being more proactive in collaborations with other brokers. So I think definitely, as from a broker's perspective, it is a great time. As much as it is challenging, it is great in the sense that you do have obviously access to infrastructure. The industry itself feels like it's being very progressive, and with that progression, obviously comes opportunity. Indeed. So before we go into that section, let's just talk about what seasonal trends are at play at the moment, and in particularly where we're at in terms of possible challenges in that sort of January, February period.
Yeah, so and this is again just sort of much more my opinion, but traditionally January, if you look at bankruptcies, there's a spike. So if you think about a small business person, everybody, they have a nice run up to Christmas, hopefully, but it means if your business also isn't quite performing, you're sort of hanging on for that Christmas rush to sort of try and clear the decks. If it doesn't, then you then go into January where invariably everyone's on holidays and your sales fall right away. You've got all your staff on holidays, but you're still paying them. Your cash flow goes completely around the wrong way. And then come February, You then have to buy in more stock, restart up the engines, get the thing moving again, which again requires cash flow. So it's always at the end of January, February that you see the spike in people putting their hands up and going, sorry. Actually, last year was pretty tough and I'm out. So I think this year we haven't had bankruptcies in this country for, or an uptick in bankruptcies in this country for some years. So we certainly have to wind back, a long way back, really. So this January, this February, I think will be very interesting to watch. I don't think it's going to be a all over Red Rover for, a huge number, but I do expect to see perhaps more washing through the system than we've had in a long while.
Yeah, and I guess conversely, again, from putting my commercial finance hat on, this is the opportunity for brokers right now to ask the question of their business customers, what are you anticipating over the next, say, quarter or 2 quarters? And in particular, before things become crazy busy, to sit down with, in particular, business customers, look again at historic data and preferably look at that in conjunction with an accountant to very much work out strategies to smooth out cash flow that are going to be advantageous, obviously, in terms of working capital, but also potentially have, minimize tax implications. So right now, my top tip to brokers would be to look at business customers and just really look at that working capital health check, see what that is going to potentially look like for the next few months. And if you don't have the skill sets to do that, to then partner with a broker that does work in that space, or partner with an accountant, or so on and so forth, so you can really help that customer in advance. Because again, being on the lending side, I've heard lenders say on countless times, if you're the lender of last resort, it's often difficult to then help that business. So the more proactive the business can be in terms of anticipating finance in advance, then the stronger position that they're going to be and the less exposed they're going to be, particularly in that January, February period. And I guess offsetting that is, if inflation does continue to go up, costs of goods continue to go up, that cash flow discussion in advance is critical.
It is. And as we've spoken about already, it's only going to get tougher to get that sort of cash flow financing. Get that undrawn overdraft, if you like, an old-fashioned expression, an overdraft. But just make sure you've got it in place if you're that medium to small size business.
Yeah, absolutely. So in terms of any questions, please feel free, obviously, to shoot those through. But as they come through, Nick, what we might talk to is what your tips are for brokers to ride this next wave, which I know we've sort of been dancing around from a commercial finance perspective, but holistically, let's start with say more the residential and investor space. What would your tips be to brokers?
So, and it's been it's almost a bit of a broken record, this, but you've just got to be so close to your back book. So, again, when I started out in mortgage broking, it was all about getting new customers. It was about getting new people in the door, getting new loans out the door. The game for the last 12 months, probably the last 2 years, is about refinance. We've spoken about it. So either you refinance them or somebody else will. But that's the game. It's much more about refinance than it is actually about finding that new customer. And some brokers are really good at just constantly going through and have got all sorts of procedures and processes in place to regularly, whether it be health checks, whether it be whatever's. But that's the game. And, I couldn't encourage people more to really think about a systematic program. So rather than, I might call some of a better role, some of my clients today, I'll call up, 2 or 3 today, and, then I'll get distracted. Put in place a proper system and stick to it, every every 3 months, every 6 months, one way or another, I will touch every single client and have a whole program to also start categorising them. Okay, these are investors, these are just home buyers, these are first home buyers, these are commercial, and think about where they would be at and what they would be experiencing, and therefore what sort of refinance opportunities will they be thinking about. So that's
I think you're absolutely right. And just to put my marketing lens on that, the more segmented you can be in your approach, the more impact you're going to have. So if you just think of sending an email blast to your entire database, if I am, say, an investor and you're emailing me about SMSF or other, am I going to be that interested in it? Like, perhaps not. But to Nick's point, if you can segment your database into residential homeowners, investors, SMSFs, business, of course there's going to be overlay, but in terms of the primary loan purpose, in terms of how you've helped that customer, that provides you immediately a way to resonate with where they're coming from. So that's not saying this product is going to be great, because it's actually doing the opposite. It's where can you help? What scenario can you step in with, and how can you benefit that customer? The other thing I really encourage you to do is, if you look up Calendly or Google Meets or whatever software it is, but having at the base of your signature an opportunity for your customer just to schedule a 15-minute discussion with you, it is the quickest and easiest way to actually instigate a call to action from your network. And where I've seen it work is just, again, more on the lending side, is when BDMs have that at the base of their signature, and the number of brokers who contact the BDM through that. It's a really quick and easy way. So to Nick's point, as brokers, I think that the opportunity is to very much segment your database, be very specific in your communications of how you can help them, and off the back of that to really be on the front foot. But equally, as Nick said, again, if you don't have a CRM, if this isn't processed and systemized, you're going to spend a lot of time thinking about it and spend a disproportionate amount of time not doing it. So the more things are systemized, the less you have to actually think about it, and the more effective that you become. But Nick, I am hijacking your webinar.
No, you're doing very well. Well, of course, Sasha, for those of you who aren't aware, Sasha is an industry-leading marketing expert who specialises in the mortgage broking industry. So she does actually know what she's talking about.
Thanks, Nick. I appreciate the vote of confidence. And yes, I try to limit the hot air. But on that note, we don't have any Q&As that have come in, so we might just wrap a few moments early. So thank you so much to everyone for tuning in today. We really hope that it's been beneficial. We'll be in touch shortly. We'll provide the graphs that we referred to today, as well as the CPD points from the MFAA and FBAA. So Nick, as always, thank you for your tremendous insights, and we'll look forward to speaking to you again.
Thank you, Sasha. Thank you all. Bye for now.
Bye.